In our introduction, we learned that Forex, foreign exchange, is the global market where currencies are bought and sold. This market exists because countries, companies, banks, travelers, and governments constantly need to convert one currency into another to facilitate trade and economic activities. In Forex, currencies are always traded in pairs, where the first currency is known as the base and the second as the quote, for example euro to US dollar to Japanese yen, or pound sterling to US dollar. Now, when it comes to investing in Forex, you need to understand that every currency reflects the strength of its country's economy. As an investor, your goal is to identify a stable currency that is likely to appreciate against another. This decision is based on key factors such as interest rates, inflation, economic news, political stability, supply and demand, and overall market sentiment. For example, as a Kenyan, if you notice economic conditions affecting the Kenyan shilling, you might decide to move your value into stronger and more stable currencies like the US dollar, British pound, or euro to preserve and grow your purchasing power. However, one important thing to understand is that currencies do not move in large percentages like other assets. This is because every country actively works to maintain the strength of its currency in order to stay competitive in global trade. Because of this, making significant profits through Forex investing usually requires larger amounts of capital. To invest in Forex under this model, your main brokers are banks. Banks act as the gateway that allows you to buy and sell currencies. They can hold the currency for you digitally in foreign currency accounts, or you can choose to withdraw and hold the physical cash yourself. In return, banks charge service fees, which is one of the ways they make money. Another major way banks earn is through the spread. The spread is the difference between the price at which the bank is willing to buy a currency from you, bid, and the price at which they sell it to you, ask. For example, if USD KES is quoted at 140.00, the bank might buy from you at 139.50 and sell to you at 142.00. The difference between these prices is the spread, and that is part of the bank's profit. You can often see these rates displayed on screens inside banking halls. In Kenya, banks such as Standard Chartered Bank, KCB Bank Kenya, and Cooperative Bank of Kenya provide these foreign exchange services, making it possible for you to invest in currencies through the investing model. That's how you interact with Forex as an investor, by owning and holding currencies based on economic strength and future expectations. In the next lesson, we'll move to the next asset class, which is stocks, so stay tuned, and don't forget to like and subscribe.